Hello investor, hopefully you are having a wonderful time. In today's video, I'm going to cover the Canadian National Railway. The ticker name is CNR. This is the Canadian stock, but also is listed in the US Stock Exchange. Myself, Pramod Kumar, I am a CFA charter holder and FRM certified. As you can see on the slide, this analysis is totally based on the third quarter of 2020, right? So which is the latest one. So this is the ticker name on the Toronto Stock Exchange, CNR, but in the NYSE the ticker is CNI, right? But both belongs to the same company, which is the Canadian National Railways. This is the very big agenda for today. So let's get started without further delay. So pretty much this is a very wonderful stock, and I'll keep a surprise from where why I think I should be doing this. But the main reason of doing is I'll come, but let's first understand is a business profile. So CN in the Canadian National Railways, right? CN in short is basically the rail and related transportation business, right? And it has 20,000 routes miles. So basically what it is, it's this is a Canadian National Railways. So basically it's an in the railways they transport goods and services right across the customers to the Canada, United States, Mexico. So it has a very broad network as well, right? So it handles 250 billion worth of good annually and carry over 300 million tons of cargo, servicing exporters, importers, farmer and manufacturers. One thing to know there, one thing I like about here is look at the revenue diversification right up front. If you have on this one, the CN Freight Services revenue derived from 7 categories, right? So this is the 7 categories, right? Diverse, balanced portfolio, right? The largest commodity group account for the 25%, right? And from the geographical standpoint, 16% is coming from US domestic traffic, 34 is trans-border traffic, 17% is Canadian domestic, and 33% is overseas. So not only from the geographical perspective, it's diversified, right? Diversified, but also maybe I'll do like this, but also from the revenue perspective, we see this is very well diversified. So that's why I really like about this company, right? So let's start. And another cherry on the top is this is the dividend paying company, right? It pays the quarterly dividend of 1.67%. The dividend yield, you might think, oh, it's not that, maybe it's lower as compared to our RioCan and Suncor, which I just stated. But if you see the dividend growth rate, right, it's 12.5%. That's a 5-year growth rate. And then the 3-year is also not bad. It's 11.02%. So every quarter, this will give you 0.575 cents in the Canadian, and you can convert in US if you have, or the US, because this is CNI is also US tickers. Okay, so if you buy the stocks before this date, you will get the dividend at this time, right? So that's what it's trying to say here. Okay, now let's quickly look into from the valuation perspective. Right now, this is $97 billion company, and the return on equity is very good, right? It's 18%. It's excellent. And the return on asset is, for this year-old company, is 7.63, is amazing. The price, how much price over the book value, is 5 times it's asking right now. The P is, I think, is a little bit higher right now on 28, but I also do when I do the industry comparison, I will go into the more deeper into that, right? So don't worry about that. Okay, so this is the chart on the, as you can see, if I got from Yahoo Finance, this is cnr.to, and then you see the right now the price is as $137. So what it's trying to show, so basically I go to the max, right? And say, okay, on the weekly basis, if if we invested somewhere in, let's say, like 1997 or very beginning, and this stocks will get around this much return, right? 2739.92% return. Whereas if I compare this with S&P 500, the return was only 330. So you see, this is the huge return. So this is a kind of a stock, and you see this chart right here. We just buy and forget it. For example, in Canada we have like RRSP. I think this is a very good candidate, but just looking into that as well. But do you think, should we think, because this is a 100-year old company, right? Because Canadian Railways has not set up any time recently. It's a very old company. So let's see how is a recent financial statement with the with the COVID, how it affects, and if this is out, is any other super investor like Warren Buffett or so has invested in that company? Because I think for example, the Suncor, which I have recently did it, the Warren Buffett invested recently in that company, right? So that's also proof that is pretty value stocks. And I did analysis on that, and if you haven't checked it out, feel free to check out that video, and I personally invested in that. This company I haven't invested so far, but I am going to do if the stock price honestly crash. That will be my first, because I want to go lower and big, so, and I just leave and forget for next 20 years. But should I do that? Let's keep going, right, to see. I don't want to reveal anything right now. Okay, so for sure we know this is the 100-year Canadian National Railway, 100-year-old company. So let's quickly see some remarks of their CEO, right, J.J. Rust, the president and CEO of CN Railways. So what he's saying, the CN people never stopped working since the beginning of the pandemic, and I'm proud of the essential transportation service they have provided, right? So this means the company is always generating the revenue, right? Even if some out of the 7 revenue streams, some are lower, but other is picked up, right? So we can see, okay, the volume in terms of the revenue, it was decreased by 11%, right, from their quarterly statement. Okay, we know that. Okay, EPS is for sure, I expect to be decreased as well, right? But one thing, it's really stand out here on the free cash flow. The free cash flow from the first 9 months of 2020 was increased by $588 million. So how much it was? It increased to $2.087 billion. So this is with a B, right? And that's, I'm just talking about the 9 month. So that's amazing. So this means this is not like a old company which is hard to adjust its finance. And I'll show you in the next slides how they are doing that. So okay, so this is again on this slide, they assume they have the V-shaped recovery, right? V-shaped recovery on the ports, lumber, and automotive sector, right? And these are the sectors. These are the areas where driving profitability and growth, right? The grains has a record export, so for sure grain people need to eat, like coal, propane, have a right and all, right, and all. So I don't want to go in detail, but for sure they saw some little bit dip in when the market crashed, but it was just for the temporary, right? And then the market improved. And this is from their Q3 statements, right? Nothing from else. Okay, so in this one, when they say, okay, they have a good cash flow, this is why I like it. This is their operating expenses, right? So they improved the operating expense by 8%, right? And therefore they have the good amount of cash flow. So that's why I have put this slides. I have a lot of material to go. I don't want to go into each section, but you can see wherever is positive, this mean is good, right? And negative, so this mean fuel efficiency and all. So you can pause and look. But if you want to take one thing from here, is this is an old 100-year-old company for sure, but they still can improve their their operating expense. So that's I really like about it. Okay, so now let's go from the income statement here, and then we'll go to the balance sheet and cash flow, and then go to the industry analysis from there. So going more deeper into deeper, right? So if I see from the margin perspective, so this is the annual, okay, because right from December year end 18, 17 and 16, right? So you can see pretty much is revenue is growing up, right? So this is going up, right, consistently going up. The net income, right, it was higher here in 17, but it's has a dip, but here, and then 19 it has a little bit dip as well. But overall, if you see from the past trailing the 12 months, right, from here, it's 74%, which is amazing. Honestly, I was not thinking that much into the gross profit margin, and operating margin is also amazing, right? 34.1%. Net profit margin, look at this, 25, almost 25%. If I see 24%, if net profit, if you take any tech company, it must be over 30 or 40 multiples. But look at here, right? When we see the multiple, like let me quickly go back, it's 28, right? So a little bit over, so it's not that bad from that perspective, right? But this is a different sector, right? So we need to see from the sector perspective. I don't want to give any wrong comments here. Okay, but I was just thinking if we want to compare, right? The return on investment is also very good. It's 8.63%. So overall, from the annual perspective, it looks, from me, I think it looks great, right? Again, from the quarterly perspective, if I see here, only the June, you see the revenue got a little bit dip in June, right, because of the coronavirus, but then it got picked up again in the third quarter, right? 200, it was good in May until March, and then it got a little bit dip, and then it goes up, and same thing on the reflected in the net income as well. So this quarter, I think most of the companies make sense, right? Because this is something unusual we haven't think, but still, because even all this happening, the company did a fair job to control its expenses and come back here. And the good thing is the top line is increasing, right? So that's pretty good thing, which if top line is increasing, you do nothing, but overall everything will go up. Why? Because you have a great margin here, right? That's telling the story. Okay, from the balance sheet perspective, I just want to see from the liquidity. Liquidity, we already know they have a good free cash flow. I expect to see at least one. The current ratio is close to 1, so that's not bad. The quick ratio is closer to 1, so that's fine. It's not bad. It's okay, right? So, but a good thing is if it's greater than 1, then even is better, right? But it's pretty much closer, so not bad. So let's come see now next on the cash flow. So the cash flow statement, now it's always good to see whether the company is only operating or actually generating the cash as well. So here I see on the yearly basis, the company is consistently generating the good amount of cash from its operation, right, from its core business. So this is a core business, right? Almost 6 billion, almost 5.5, 5.2, 5.2, so it's increasing here, right? So that's great, right? The company is also not only doing that, but also investing its money. So that's again is good. Okay. And seems like company is giving back in terms of dividend, and so it's negative here, or the share buyback, so how the company is doing in terms as comparing to the industry as well. So if I see from so this is the ratio for the company, and this is for as comparing with the industry. So all these ratio, if I compare with the industry, right, this is the industry, then it looks expensive, right? The PE is 30, sales is 7 point something, and the price to book is 5, right? But does this support by is earning growth or the sale growth, right? These high multiples. So let's look into that. If it's support by higher multiple, then this means it's good. Otherwise, we think this is the company is a little bit expensive. Okay, so let's get started. So this is again the industry, and this is the company, right? So we can easily see the company, the gross profit margin is way higher, right? If I compare even the trailing year from now to the past 12 month, or the 5 year, the growth, right? It's 75. We can see the industry is nowhere near. 5 year is only 61. So this means, so that makes sense why the and why it's good, right? So that's, at least from here it looks good from the top line. But if I see from the bottom line perspective, right, from the, if I compare from the 5 year average, right, from this one, right, this is a 5 year net profit margin, you can see the difference. This is 34% and this is 23.2%. So I didn't see that. I think that the company is doing good as compared to the industry. So it's require some higher multiples, right? The company overall. Okay, so the revenue perspective, the company is generating $19, and the book value, so, and the cash is flow per share is 7 and it's 8. So that's okay. The overall margin, I think the company, if I compare with this margin, is good, right? So that's very important, because the multiples might be affected because of the little bit higher price and other factors, right? I don't want to go too many detail, but overall, if I compare this means the stock is good as compared to its industry. Okay, the next thing I also want to highlight in this slide is the return on investment capital, right? So this is from their annual statement, right? Sorry about that, maybe I'll write nicely. Annual 2019 annual statement, right? You can see this is almost 16 or 15%. Let's stick to it, right? So the company is giving 15% return in terms of the capital investment. So if you invest, it will give you the 15% return. That's what it's trying to show the math here, right? Even after adjusting this is after adjusting. So this is the adjusted, even when they invest in the capital or other. If I just take the ROIC, it was 22.7, 16.7, 15.7. It's reduced, but overall is still conservatively, if I say, it's 15%. So it's pretty good. Okay, now I like, so this is the stock is a part of the Gates and Melinda. So they have a trust foundation, and this is the 8.49. So when I was maybe a month ago or so you can check out my channel what are other stocks the Bill Gates Foundation owns. So this is the 8.47. So when I was doing the analysis of the stock that time, I found, wow, this company is so good in terms of the price returns and even in terms of the dividend returns. So I thought maybe I'll do the video on that one, but I didn't ever get a chance. So but now when I'm doing the series of the dividend side on the Canadian stocks, so I thought, okay, I should be analyzing this. So if the next time the market dip comes, I will go and buy this into this. So right, so that's what this is. And 8.49, honestly, for such a big portfolio of the foundation, it's not a small amount, it's a very big amount. So if you haven't seen that, feel free to check it out, that video on my channel as well. That's under the portfolio playlist. Okay, so now we have seen the company is very strong in terms of the returns. The company has a diversification, paying dividend, price return is good. So what next, right? So how the company is paying. So that's what interesting I have found. The company also doing share repurchase, right? So 14.3 million of common share purchase, returning 1.7 billion to the shareholders, right? And this is in addition plus, right? So this means the company is doing share repurchase, So therefore, you can see the graph, the number of outstanding share because of their share purchase is lower. So if the share outstanding is lower, right, which impact the price, right? If the price goes higher, so this means we'll get more price appreciation, right? More chunk of the pie. Plus the dividend is also increased, right? It's increase the dividend per share, right? Effective. Right, so that's also you can read here. I checked on their quarterly Q3 statement. Now they are not doing because of the uncertainty in the environment any share repurchase, but that I taken it from the 2019 annual statements, right? So that's from there. So maybe next year they will resume share back again, but that's the management haven't said that. At least I haven't find that, but that's what they have done in terms of a share. But from the dividend increase and all, or dividend giving, that's still a code, right? So now what we think. So if I see from the summary perspective, honestly, so I got some of these key points. So the first point is for sure, this is the revenue diversification, very first, right? Uninterrupted dividends. This is a part of in Gates Foundation. The company has a big history, right? Higher margin. Plus, this is the very important, I like to highlight, high barrier to entry. This is the Canadian National Railway, right? So railways, you cannot just set in a one day or any other big competition can found. No, these are the bulk of goods, like big, those those cars, they're transferring the goods, and so I don't think so. So that's require a very big investment and all. So that's not easily be replaceable, right? And on the price side, I think when I did some math on it, so the price is also right now is the fairly value. This doesn't mean right now the price is 137. I believe the price should be around 140 as average. So the price wise is that's the Canadian the ticket price. So that's the fairly value. So that's my take on it. So I think from my perspective, if the company, if this next stock market comes, for sure, I'll buy this in a bulk, right? Or if it doesn't come as well, then I think I'll just wait for maybe until next month, and then just go and buy this for my RSP and retirement, and just leave it for 20 years to in my account until I need it there back. So for sure, thank you for watching and your wonderful time. Please like this video, subscribe to the channel if you're new, and comment your other favorite stocks, and also let us know, like if I notice people want me to cover their stock, but also if you can put a line there why you think that's important from your perspective, right? Why you want to add it. So this will give some background as well, whether you are just looking from the long-term investment or looking for certain growth perspective from the short time, at least for 1-2 years, right? So that will be helpful to know as well. Okay, so myself, Pramod Kumar, I'm a CFA charter holder and firm certified. Thank you, and hopefully see you soon in next video, and bye for now.